Good evening. Welcome to We Mean Business. I'm Manisha Nair Dhawan. The Rajiv Gandhi Equity Savings Scheme RGESS was announced by the government in the last budget to give tax benefits to first-time equity investors, which would have also been a boost to the stock markets by channeling savings into equities. But in the first financial year of its launch, RGESS has seen only a tepid response. Is RGESS a missed opportunity? Can it attract more funds in the subsequent years, or will it have to be tweaked yet again to make it more investor friendly? To discuss this, I am joined by Sanjay Sinha, founder of Citrus Advisors, Mr. A Patel, CEO of Quantum AMC. We've got Mr. Yogin Sabnis, CEO of VSK Financial Consultancy Services, Mr. G Chokkalingam, ED and CIO of Centrum Wealth Management. Good evening, gentlemen. Welcome to NDTV Profit. Let me start with you. Mr. Patel, how has been the response to the NFOs launched by mutual fund houses to RGESS?
It's too early to say or speak about the responses. Probably we'll have to wait for a few more days to get a first-hand info on the collections done by the various NFOs in the industry and the response in terms of number of investors who have subscribed for the product. So probably 2-3 days more and we'll get the clear picture.
Right, but Mr. Patel, the initial reports have suggested that the response has not been overwhelming. It's very lukewarm. Do you think is it because it was launched, the NFOs were launched a little too late in the financial year, people had already done their financial planning, or is there something which is a deterrent for investment in the scheme itself?
Probably if you were to look at the investors, this investor is a retail investor whose income is 10 lakhs or below, and most probably he might be a salaried class investor. In most of the organizations, declarations for tax deduction has to be submitted by Jan, while the clarity on the product, the circulars came in December. The launches happened only in Feb or late Feb. So by the time the launches or the NFOs were launched, bulk of the investors who were salaried class missed the bus. So yes, there was a little delay in the launch of the product, but in addition to this, people can still claim the benefit by filing their return of income, and the hope was, and it is, that people would have invested and taken the additional tax benefit which was announced by the government.
Right, Mr. Chokkalingam, do you like the premise of this scheme? We already have a competing scheme, ELSS, excuse me, where you have a 3-year lock-in and you can invest in mutual funds which then invest into equities. Now, RGESS is offering first-time investors a scheme where they can park 50,000 rupees into equities and they will get a tax deduction of 25,000 rupees on the entire taxable income. But does this really work? A 3-year lock-in for something equities, which is a long-term wealth creator, is this a paradox?
I firmly believe that there is a big mismatch between the objective of the scheme and the tool used. I agree with you, there is a big paradox, because the attraction of the investors to the equity market, in my understanding, depends upon 2 parameters. One is the return and the second is the risk. If you see the return, it is quite pathetic. Most probably the investors who have income of more than 10 lakhs or 12 lakhs would have most probably already had a demat account. So the real target group would be around 5 lakh plus income group. But here, if you look at the tax benefit, which would be roughly about 200,000 rupees, which is about 5% of 50,000 investment they make. So considering the fact that equity asset classes are very risky, the 5% benefit is, first of all, it's very low to attract. And second, the equity asset class is a very risky one. If you look at Nifty 100 or BSE 100 stocks in the last one financial year, almost 50% of the individual stocks have led to the losses for the investors. Or even if you take the PSU stocks and even extend the time period to more than 3 to 5 years, almost 50% of the PSU stocks have led to huge losses for the investors. So therefore, unless the risk parameter is addressed, the benefits are proportionately increased, there will be a big paradox, and I doubt whether this scheme would be really successful in the country.
Right, Mr. Sabnis, Mr. Chokkalingam spoke about risk, which is very important. The government, do you think it is fair for the government to induce individuals to take risk with an inducement of tax saving when the government itself is stopping the PPF authorities, the pension funds from investing so much in equities, but they're encouraging individuals to take risk for saving tax? They could even lose money should the equities lose their value.
Yeah, actually I have a problem with the entire concept itself. Asking the investor to get into, somebody who has never invested in equity, to get into stock markets directly is asking them to take a lot of risks. I have seen investors who have experience of 10, 20 years even doing the same mistakes and losing money. I mean, they are, in spite of being in the markets, they are still not able to really capitalize. Now, when we talk of the new investors who have never invested in equity, if they are going to invest directly in the stock markets, who's going to advise them?